Honourable Senators, this is our fourth meeting on our special study focusing on access to credit and capital markets for small and medium-sized enterprises as the basis for growth and improved productivity in the Canadian economy. I wish to welcome our witnesses. With us are Ms. Annie Sénégaliese, Chief Executive Officer of the Canadian Independent Finance and Innovation Council, and Mr. Jim Dale, Chief Executive Officer of Lead Financial, Inc. If I understand correctly, you do have some opening remarks. So the floor is yours, and welcome. If we could wait a moment. I believe we have a technical problem with one of our witnesses. It won't be long.
Donc, je pense qu'on a réglé.
I think that's been settled. I think that's been dealt with. So, once again, welcome to Ms. Sénégaliese, and Mr. Dale, the floor is yours.
I will call it CIFIC going forward because the name is very long and we have a short amount of time, so I will just call the company CIFIC. So CIFIC was created 2 years ago to become the voice of investment dealers in Canada. We currently represent 42 dealers, mostly independents, all across the country. And our goal is really to solve their challenges. So we asked our dealers what was the main challenge in Canada right now. And what they said was junior capital markets. So for them, startups have to go to junior capital markets and then graduate to senior markets eventually in order to create jobs and bring wealth to Canadians. What's happening instead is that a lot of these startups are being sold to foreign interests, and this has to stop. And it's a good sign when I see senators nodding yes. Just to be transparent, about half of the dealers that we represent do not participate in the junior markets. And when we asked them why, they said that it was because of the regulatory burden and because of the high costs, mostly related to the client focus reforms. The half that did participated because, and I quote, somebody has to do it. So to them, the junior issuers are a critical part of the Canadian economy, and they have to be there for these companies. I'm not an expert in junior markets, but when I heard that, I thought to myself that this is really critical, and our financial ecosystem is on the verge of collapsing. So I will now pass it on to Jim Dale, who is an expert on the junior markets. So as you said, Jim Dale is the CEO of Lead Financial, but he is also the chair of our independent dealers group and our governance panel.
Thank you, Annie, and thank you for the invitation to speak with you today. This is a topic that is of great importance to our industry and our country. Along with Annie, as she mentioned, we established CIFIC to represent Canadian independent, or in other words, non-bank-owned investment dealers. I am the CEO of Lead Financial, and I'll give you a little background of the firm. Lead is a mid-sized dealer with 140 investment advisors that operate from 20 locations in Canada. We have offices from Vancouver Island to Prince Edward Island and service clients in both official languages. Our firm's roots go back more than 50 years. Investment dealers are intermediaries between companies and investors, both institutional and retail investors. Prior witnesses, Professors Wilson and Tingle, provided excellent commentary and recommendations that focused primarily on the barriers Canadian companies face in going public. My comments will focus on the retail investors, as they are essential to the junior capital markets, but their participation has declined steadily in recent years. There are many companies that need capital, and a public listing would be more likely if we had more retail clients willing and able to invest in them. I'll outline some of the key issues. Retail investors are becoming less and less likely to be introduced to the junior listed companies. And why? Well, first, there are fewer investment dealers due to consolidation, and very few new dealers being created due to regulatory barriers to entry. Next, many of our existing dealers have shifted their business model to wealth management, where revenue is fee-based instead of the traditional advisory model, which charges commissions on transactions. And lastly, dealers can avoid some of the additional regulatory costs and risk associated with client-focused reform rules, such as the Know Your Product rule. The KYP rule, as it's known, has resulted in dealers removing junior companies from their products that are approved for their advisors. Even where advisors have access to the junior listed companies, only the wealthiest investors can readily access these advisors. This is largely due to the high costs of servicing this business, which results in minimum account sizes. Accredited investor rules and syndication practices limit retail client participation in new financings. New financings have historically been a source of new clients. Further, as you know, bank-owned dealers are risk-adverse and steer their clients to dividend-paying stocks, mutual funds, exchange-traded funds, and GICs. So they avoid the junior markets. Many retail investors have self-directed accounts with online brokers, where they do have access to junior issuers, but are less confident investing in them without additional research and advice that advisors can provide. And some retail investors are discouraged by the impact short-selling practices can have on illiquid junior stocks. This causes them to put their money elsewhere. Risk capital is now competing with cryptocurrency, betting platforms, and more recently, prediction markets, which are almost barrier-free, and in the case of betting wins, tax-free. Compare this with tax that is paid on capital gains. There are federal measures that we believe would stimulate investor participation in the junior markets, and the four most important are: 1, eliminate capital gains tax on early-stage public companies. These are companies that I would say have annual revenues below a certain level, maybe $10 million. Second, allow the deferral of capital gains for other venture-listed companies where sale proceeds are reinvested in the market within 1 year, similar to the UK program. 3, extend the lifetime capital gains exemption that is currently available to Canadian private companies to Canadian public-listed venture companies. And 4, extend the flow-through share incentives that are available to resource companies to all early-stage venture companies, passing the tax write-offs to the investors willing to put their capital at risk. We also have some recommendations for our regulators. We need to modernize the accredited investor rules and limit their application. These rules do more harm than good. We currently exclude 95% of Canadians from participating in non-brokered financings. Investment advisors that are subject to Know Your Client rules already have responsibility for investing their client money in accordance with their defined investment objectives and risk tolerance. So these rules are redundant. We also need to prohibit short selling for venture-listed securities that trade below a defined threshold. There may be exceptions for market makers and liquidity providers that must continue. Also, we need to encourage greater retail client participation in new financings by establishing a minimum allocation for retail clients. Currently, 100% of new issues can be taken up by institutional clients. We believe these changes will significantly improve investor confidence and participation in the junior capital markets. I'll now turn it back to Annie.
Thank you, Jim. So we actually asked dealers that we represent what would success look like in junior capital markets. So what they said was they wanted to see increased IPO activity and secondary financings. They wanted to see greater liquidity. They wanted to see better price discovery. But most of all, what they wanted to see was a healthy pipeline of companies that go from startups to junior capital markets to senior markets. That to them is what could bring more job creation in Canada and more wealth for all Canadians. And when we asked them, how do we get there? They said that everyone must work together. So we're very happy to be here because we feel that the Senate, the Parliament, regulators, but also issuers, dealers, and investors have to work together to implement solutions on different levels. So, and we believe that the Senate is actually able to encourage fundamental changes in Canada. Thank you.
Thank you for your opening remarks. We are very happy as well that you are here this morning. We had the core of our discussion, and thank you for sharing some solution. So, colleagues, we have around 60 minutes. What I propose is maybe 5 minutes each, including the answer. So, starting with our Vice Chair, Senator Vernet.
Thank you. My question is for you, Ms. Senegalese. In December, you wrote a letter to the Ontario Securities Commission, and it was on the topics of CIX trading, or SIX trading as they call it. And I found it very, very interesting in terms of the points of view being offered and some of the novel concepts on fractional trading. And my question, will the implementation of the SIX trading platform enhance or impede access to capital for small and medium-sized SMEs in Canada, considering the concerns that you've outlined in that letter regarding operational readiness, fractional trading, infrastructure, and the risk market fragmentation as noted by the stakeholders?
Thank you for the question. So we believe that the capital markets must be modernized in Canada. We're looking at the U.S., and we see that they're going to tokenization. They may be there in 2 years where tokenized securities will be traded on NASDAQ, NYSE, and so on. So we have to modernize our capital markets in Canada. In that letter, however, we did say that we did have some concerns because we need to make sure that for our smaller capital markets, we take decisions that make sense for Canadians. So we believe that SIX trading, they're welcome in Canada. It's going to modernize what we do, but we'd like to see more Canadian companies come up with this type of enterprise.
For the benefit of my colleague, can you expand on what fractional trading means?
So fractional trading, it's actually happening in the U.S. right now. The investors in the U.S. are participating. So instead of buying a very expensive stock, they could buy a portion of it at a cheaper price. And so it permits them to participate in an issuer that otherwise they wouldn't have access to.
Thank you.
Thank you, Senator. So moving to Senatrice Marshall, to be followed by Senator Friedlander. Senator Marshall.
Thank you very much, Mr. Chair. So, Mr. Dale, I found it very interesting. You went through 4 suggestions, but they're all aimed at tax reform, isn't it? That wasn't my question, but I just found that interesting. But maybe I'm looking at this kind of simplistic. But like, is there a structured system whereby if someone has $500,000 to invest, that like how do they access these junior companies? Like it just seems like there's no structured process. So if I had, say, $500,000, I'd be looking at the Toronto Stock Exchange and probably looking at the banks. What's the process if you want to access these smaller companies?
Thank you for the question.
It has to be read.
Thank you.
You're welcome.
Clearly, I'm not a technology person. Thank you for the question. There's a great amount of difficulty right now to access the junior markets. It depends on who you first talk to. Because if you talk to your bank, they are more likely to steer you to other products. If you have a larger account, then you will likely be placed with an advisor, and that advisor may have access to the Toronto Stock Exchange, the TMX, but in most cases, stocks that are listed on the TSX Venture or the Canadian Stock Exchange will be unavailable to them. They won't be on the designated product shelf. And if you would like to buy them, you may have to be granted an exception by their compliance departments. So it's difficult. There are some advisors that that work for banks that are more demanding in terms of meeting their client needs, but it is an obstacle within a bank. So independent dealers fulfill more of that niche in the business. But increasingly, as I mentioned, even independent dealers are moving more to a wealth management platform that's similar to the
So
banks.
how do you change that? I mean, you want to encourage people to access these smaller companies. My experience has been people telephone you, like someone who has something on the go will call you or show up at your door and say, I have this project on the go, and are you interested in putting in a couple $100,000? But I mean, that's just, ad hoc. Like, how do you change it so that more people can access these smaller companies?
Well, I think most of the recommendations are directed at that. There isn't one simple solution to it. There's a number of regulatory changes that are required, but there also has to be incentive for investors that want to participate, that are willing to write the checks. And that's where some of the tax incentives come in. That helps de-risk their investment, or it helps delay the taxes that they would otherwise pay, causing them to recycle that money in those markets more frequently.
Thank you, Mr. Chair. Up round two, if there's
round
time.
two. Thank you, Senator. So Senator Friendler, to be followed by Senator Deacon.
I'm kind of interested in how we break down the institutional education of our regulators who are working with consumer protection legislation and believe that they have to put up gates so that the people don't lose their money and make it as difficult as they possibly can. And that's why 95% the population doesn't get to participate, and those that are wealthy enough who are believed to be smarter and can look after themselves get to participate in all the private placements and the upside on development of small companies. So you talked about the accreditor investor exemption, and you said it's archaic. Creditor investor exemption for everybody here in Canada generally is you have to make $200,000 pre-tax for the last 2 years and anticipated for this year, or with your spouse $300,000, or have net liquid assets of $1 million, or have net assets of $5 million. If you have that, you can invest in all these companies. If you don't, you can't put the money in. Now, you've indicated that on broker private placements, you're already covered because brokers have the KYC, know your client, so they have to understand when they put someone in. So the consumer is getting their protection. And so I don't know if you're advocating that there be no maximum amount someone can do. It's open season. And then for non-brokered private placements, where a lot of issuers will just go out and knock on your door and say, put your money in my company, would you advocate that we should be able to do that, or should we have some ceilings and look at that? But get rid of this oppressive consumer protection that the regulators exercise.
Thanks for your question, Senator Friedlander. That's an excellent question, by the way, and it's complex. The answer is complex because, as you say, the accredited investor rules bar a large majority, I say 95% of Canadians from participating in the non-brokered investments. However, investors at firms, at independent dealers, are introduced to those deals. And that's where the redundancy occurs. The accredited investor rules are layered on top of existing rules, and clients that would otherwise be qualify for higher risk investments to some degree are being excluded from those deals. And in the process of being excluded from that deal, they often also are excluded from the benefits that are attached to the deals, like broker warrants, warrants, not the broker warrants. The warrants are effectively an option that they can exercise in the future at the same price that the issue was at, that rewards them for for taking the risk. So the wealthier investors are able to access those warrants. The other 95% can buy those same securities on the market if they have access without the warrant, but at the same price as the issue is being done at. So that's why I say it's harmful to investors. It penalizes the less wealthy Canadians.
Thank you. Other question? Okay.
Second round.
Okay, thank you. Thank you, Senator. So, Senator Deakin, to be followed by Senator Lafreda.
Thanks very much, Chair, and thanks Ms. Senegalese and Mr. Dale for being here. This is a really important topic. This is at the end stage of a successful company growth plan that's been hard to raise the money to get to that point. And we see too many, as you pointed out, of our most promising companies exiting to the U.S. or going public in the U.S. because the challenges are so great here that contrast dramatically to the industry I worked in the 80s, from the late 70s to the end of the 80s. And you spoke, Mr. Dale, about the regulatory burden, not just on the companies themselves that go public relative to staying private, but on the dealers themselves and the relationships that they have. I, in an op-ed with Harry Pendes back in June, pointed to the Big Six as being a part of that. To change to the Bank Act in 1987 as being a pivotal moment, or a hinge moment, as our Prime Minister likes to say, in this industry, what was my industry. And I've seen it in the companies that I worked with before coming to the Senate. Can you speak about that? I'm focused on a solution of deconsolidation of our financial sector, because I just think there's too much control with 6 men behind 6 doors, and we don't get the competitive energy at the foundation of our economy. This is a lifeblood of our economy, and we just don't get it. Just, if I could start with you, Mr. Dale.
Yeah, thank you, Senator. Yeah, I agree 100%. There's our financial industry is highly concentrated within the 6 large banks. More than 90% of Canadian wealth is managed by those 6 banks. And not just their wealth, but also loan portfolios extend to the same companies that are looking for capital or considering going public. Their banking relationships with those clients often dictate how they go public or whether they go public, whether they qualify to go public. So I agree, there's far too much power within the banks, and the companies like ours are operating as a niche business in Canada, and it's becoming more and more difficult to remain in that business with the regulations that are following.
Ms. Senegalese, can you give me some sense of the number, like the shrinkage in the industry? Because when I go back and look back in the 80s about the number of independent dealers, I mean, it was owner-operated businesses. The people taking the risk were investing the money in the company. Now we've got a handful that are really having trouble participating in capital markets, as Mr. Dale has mentioned, and are being regulatorily squeezed in terms of the ability to... Can you give us some sense of parameters of how that shrinkage has occurred?
So right now in Canada, we probably have at the maximum 150 independent dealers at the most. About 100 of those will service the retail investor, and that's it. Out of our 42 members at CIFIC, we only had about 20 that participated in the junior capital markets and these types of deals. So that's why we're here, to raise awareness.
The size of their activity in the whole ecosystem of capital deals, how would that compare to what is being dominated by the banks? I mean, it's single digits.
Probably.
Yeah.
I don't have the number, but yes.
I'd love it if you could forward it to the clerk. Any evidence you have in that regard after the meeting, I'd be really appreciative. Thank you.
Thank you, Senator Deakin. Senator Lafreda, to be followed by Senator Youssef.
My question is for both, and thank you, Ms. Senegalese and Mr. Dale for being here. I'll continue on that, but take another tangent to what we're discussing. my question is, going public still a viable growth path for Canadian SMEs, or has it become too complex and costly? And are we losing promising Canadian firms because going public domestically is no longer attractive? You've raised some of those concerns. And economic sovereignty is a concern. Are we at risk of becoming a farm system for foreign acquirers of Canadian innovation? Because they do go public. And we do know, I've raised it before, like Fidelity Investments has 4.5 trillion of assets under management. Canada, even the banking system doesn't compete with that. I think it's 3 trillion in Canada. So my question is, would stronger domestic institutional investment mandates make a difference? Is there, name two barriers preventing the SMEs from listing in Canada? And is there anything we can do on policy or financial measures that we can institute to help out with those concerns? I think they're important concerns.
Want me to go first? Yeah, so I'm going to speak on my own behalf on this one. Unfortunately, I don't think that we have an environment in Canada where companies can flourish easily. Like I mentioned during the opening remarks, when we went to our dealers and we said, what do we need to do at this point? And they said, we all have to work together. I think, universities have to get involved and develop that talent. And, further than that, businesses have to create the opportunities. And then, the community has to support these businesses in turn. So, yeah, there's definitely a lot that we could be doing going forward.
Yeah, I can add to that. I think, as I mentioned earlier, the retail investor has been instrumental in supporting startup business in Canada that in terms of those that go public. But it is a hurdle to get there, and it is difficult as a firm to find clients willing to write the checks for high risk ventures. So the alternative to retail investors are institutional investors in Canada. There are very few long funds in Canada that participate in the venture markets. There are a couple in mining. Sprott is one that comes to mind. But largely in most sectors, we're void of any institutional investors that participate in the junior capital markets. Our pension funds are too large to have any interest in the junior markets. If they were to invest even 3% of their capital in the junior markets, they would need to have a team of people following those companies that would probably be equivalent to the size of their team that would follow the other 97% of their investment. It's not practical for them to do that. So I think that's a structural issue that we're facing in our marketplace, and it's a difficult one for us to recover from. I'm sorry, I don't really have a solution to that one.
Thank you. Merci.
Thank you, Senator. Senator Youssef, to be followed by Senator Stranguet.
Thank you, Chair, and thank you for being here. We have data to tell what the problem is in terms of what SME is facing in the country. The bigger question is, how do we get to a place that we could make some recommendation that makes sense? So I'll start for the first, obvious to me. There's always a tendency to compare us to the Americans. We're 40 million people. There's no comparison, to be very blunt about it. So given that reality, and in addition to that, we've got essentially 11 regulators trying to manage their own security exchange in whatever fashion is or whatever they decide. Jim Flaherty was the last one trying to bring them together, and of course he was beat up pretty bad. He finally gave up and said, I'm not doing this anymore because we can't get there. So in the context of the challenge we face, we can't do one thing over here at the federal level without the province reciprocating, because that's where most of the SMEs are located across the country. So if we're trying to do something really constructive and helpful to SMEs, how can we bridge this gap between the federal government and the province? Because they have a joint role to play in trying to mitigate this challenge that we face if we're going to grow the economy of the country, but also help SMEs meet the challenge in getting capital from the market.
Do you want to take it?
Sure, I'll take that. I think you raise a good point. Canada does have, I think the correct number is 13 commissions, including the territories. But we do have an umbrella organization, the Canadian Securities Administrators, that oversees the rulemaking from those commissions. And there are a lot of national instruments that do have universal application. So I'll start there. We have a passport system in Canada that has been endorsed by 12 of the 13 jurisdictions. Ontario is the exception. Unfortunately, one jurisdiction, Ontario, is also 50% of the market. So it's a pretty significant gap in terms of participation. The U.S. market has the securities, the SEC, but they also have 50 states that also have some input into how securities regulation is enforced in the U.S. So it's not entirely different. It is different, but it's not entirely different. So it is complicated and it is time-consuming. In addition to CIFIC, I am involved in some of the other, as an advisor to some of the other bodies in Canada. Some of the exceptions that we have in Canada are very difficult for dealers to operate with. It would certainly be nice if Ontario decided to join the passport system. And through that, then I think you'd be able to eventually harmonize more of the rules.
Thank you. And I think one thing also that we thought would be beneficial for dealers would be for advisor registration. Because right now, each advisor has to register in each province where they have clients. And that's 2,000 to 4,000 per jurisdiction per year. So that license is very expensive. So maybe that's something we could take a look at as well.
Sure.
Time? You have time?
Credit unions play an important role because they're local, they're small, they're more nimble. They understand their client because it's a bit of a uniqueness to their business. How can you differentiate between what the credit unions do in helping SMEs versus what we're dealing with in the big banks at the national level?
So maybe I could talk a bit about Desjardins that has their capital de risque, where they try to support regional businesses, and retail investors can actually invest, and they have a tax credit at the end of the year. And that's been around for, I don't know, at least 20 years. So these are the types of incentives that we could put forward.
Okay.
So thank you. Interesting, because this government want to eliminate barriers between provinces, but we have some angle that we have to consider, because it's not a federal government decision, it's a Ontario government decision. So it's something. And maybe with my former trade economic colleague, minister from Ontario, Senator Patello, maybe we could work on that. So, but we go to Senatrice Ringuet first.
Thank you, Chair. My first question to you, Mr. Dale, is you mentioned a UK program that seems to be very well received and meeting the goals. So could you elaborate on this program that is there?
I guess to put it as simply as possible, if you sell a junior security in the UK, the proceeds that you receive from that sale can be reinvested in other qualifying junior securities within a year, and you can avoid paying the capital gains tax. You can defer it, I should say, not avoid it. You'll pay eventually but by reinvesting those proceeds, you're not eliminating tax dollars in your next investment.
Okay. Well, we've talked a lot about investor moving to the junior market and how to achieve that, to create a certain pool, I understand. But what is the process for an SME to access the junior market? Because that's what fundamentally what we're looking at here is for medium-sized, small and medium-sized businesses access to funding.
Well, the process typically involves the SME finding an intermediary that would be willing to support them and take them to a public listing. So a firm like ours, like LEAD, we are quite involved in that. Historically, we've been more active than we are in more recent times because it's been more difficult to find investors willing to open up their wallets. But the process is that we would work with the company and the exchange to get them listed on the market. Often it used to be an IPO, an initial public offering, and there's additional protection for investors through the due diligence process that's conducted in understanding the company and ensuring that all the key components are in place for them to have a chance of being successful. More recently, IPOs are being avoided, and a lot of companies are listed in other ways through either existing listings, reverse takeovers, or other manners of obtaining a listing. But again, there's many paths to it, but it takes time and it costs a lot of money. Often the delays in obtaining a listing will require a company to refresh their audited statements, for example. And that's just one example where costs can skyrocket, and these are companies that don't have a lot of capital at the time.
Okay. Second round.
Okay, second round. So, Senatrice Pupatello to be followed by Senator Walden. Senatrice Pupatello.
Thank you. It's very interesting to listen to your comments. I have a question about government programs lately. Well, I think always, but in particular the last 10 that I've watched more closely. They come out with grant programs or loan programs specifically designed for the innovation, small companies to grow, try to find that gazelle, all this terminology with animals. I'm curious, though, about the regulatory part that you spoke of. It was always on the side of the investor, how difficult it is to make the investment, how we could make that easier for them. And then Senator Friedhandler talked about, those who aren't in the big game, that amount of paperwork just to become an investor, even on a small scale, is daunting too. If it were from the government perspective, trying to hand money to a small startup where there is a high risk, they ask questions like, we need to see your last 5 years financial statements. You're sort of like, well, we haven't been here for 5 years. Or very credible individuals who are starting a new business. So that business does not have those 5 years. But you can appreciate the government perspective. Whatever they're going to do with their money, high level of scrutiny. They need to be very sure. They can't be shown to be failing with these investments. And when we have seen that, it's always a disaster for the government. So how do you approach that where it's high risk? That's how you're taking care of your investors as well in that space and have to gauge for that. From a government perspective, what do? It's typically partnering, for example. So if they see other investors they're in, or their investment is going to leverage other investors, so you're sharing the risk. But what advice would you have on the programs that exist that you might already be aware of, where it comes to risk for government and red tape or regulatory barriers with these programs?
Well, I'm going to start off by saying I'm not an expert in the government programs that exist today. I have general awareness of a number of them. The scientific research program, for example. And a lot of those programs do a lot of good things for startup companies. Unfortunately, what they don't do is guarantee that those companies stay in Canada once they do, get to some level of success. So, my view would be that rather than place money, more money into these programs, is to let investors decide by giving them some incentive to invest in the companies, and hopefully through that mechanism, more of them will list in Canada on the public markets here.
Maybe just something that some of our dealers said, because, as you know, I just ask our dealers what they think, and then I bring it forward. They said that for a lot of the government support programs, the support should be given based on the size based on the size of a business, and not whether a company is private or public. So they were saying that there's a lot of government programs for private companies, but then a company becomes public, and it's much harder for them at that point. And that's also when they have to look for their auditors. It's more expensive, and because the junior market is shrinking, I'm coming back to your question from before, they're having a hard time finding securities lawyers, for example, to support their businesses. So it gets hard once you become public. So I think we need to look at that as well.
Have you seen that trend of public companies reverting to private? I mean, you hear the discussion of it, but is there data that backs up there's a growth in that they actually are getting out of that public market?
Again, I don't have data with me to answer that question. I think you will have a witness in the future that would probably be able to answer that question much better than I, and Richard Carleton with the Canadian Stock Exchange probably has some data on that. We do see companies that are listed drop their listings, and often that's because the cost of staying public is just too high for them. It can be anywhere from $1 to $2 million a year to maintain a public listing, and it's also the time it takes for your senior management team to conduct all the reporting, all the monitoring that's required, even completing your annual audits and all the information you need to compile for the MD&A and the notes to the financial statements is a daunting task for a lot of smaller companies.
Thank you, Senator. So, Senator Wallen.
Thank you, Chair. I don't have much voice here, so I'll ask you guys to do the talking here. You talked, we've heard much testimony in front of this committee about the lack of incentives for companies to go private with government funds or to extend funding to issues like post the first year or post the second year. So when you talk about incentivizing investors to play the long game, you mentioned the UK plan, you mentioned flow-through shares, which I'd like to hear from you on what industries other than energy you think that would apply to and how. And then just that, if there are other incentives that that you have in the back of your head about that. Thank you.
Well, thank you for the question. With respect to the flow-through incentives, currently they're available largely to resource companies, which includes energy and mining companies. But there's a number of companies that have a long build-out time in terms of developing their assets that don't have access to that program. And these are pre-revenue companies that require continued injections of capital so that they can continue to build those assets. So that would be companies that are involved in pharma, for example, that are developing drugs, which is very common in particular in Quebec, but also in BC and other parts of our country. There are ag tech companies that are developing very novel and important new technologies that are important to our future agriculture in Canada. And again, those take years to develop and get approval for and get sales coming in through their doors for them. So those are the industries that come to mind, but there are many industries that have long pre-revenue periods where they're spending money, not earning money.
Just other incentives that government could and should employ in the distribution of funds.
I'm a free market person by nature, which is what's drawn me to this business, I suppose. So I like to place the decision-making in the hands of investors. And I think the more that we can encourage that, the better. But, you know, with a high-risk sector like the junior capital markets, where you're more, you know, you can suffer a lot of losses for the occasional larger gains that you have. I think you know having the same tax formula for your gains in that sector that you would on dividend-paying stocks just doesn't make sense to me. If you can, you know, de-risk the decision-making for the investor, that would do a lot.
Thank you.
So maybe before moving to the second round, I will have a question. A lot of capital with the concentration with the banks, and we have big pension fund as well. And you mentioned too big, maybe, at some point. So I know they have, it's important that pension fund remain independent because it's not politicians who will decide in which company they will invest, which sector, even which country. But any suggestion regarding that? Do you have any experience of other country with such concentration? Any solution? Do we need to break down because they are very big? So, but the provinces have some pension fund. We have PSP, CPPIB. So, but any things that, in fact, if the pension fund is much, assuming that we break in 3 categories or whatever, remain independent, but, you know, is it something that will solve something or not really at the end of the day, because it's up to them to decide where to invest, which sector, which company. So some, I think it's like Tobrasso who mentioned that pension funds are just too big in Canada to help the Canadian companies and the small companies. So just, is it some avenue that we have to explore, or really it would be a bad idea?
Thank you for that question, but I'd have to say that's a little bit outside the area of my expertise. I would say, though, that in Canada, even on the TMX, there's probably only 60 companies that I would legitimately say are not SMEs by world standards. Most of our Canadian companies are very small companies, and when you have large funds, the nature of the amount of capital that they invest, they have to diversify their investments, but they're limited to how much diversification they can achieve in Canada. So I think it's very difficult to limit their ability to invest in other countries or in other markets without, you know, a detriment to the beneficiary of those pensions, our Canadian retirees or others that are counting on that money in the future.
Thank you. Moving to the second round, colleagues, we have some time left. Yes. We have so far Senator Veronique, Marshall, Friedlander, Deakin, Ringuette, Lefreda. Okay, so what I propose is maybe 4 minutes each for the second round. Senator Veronique.
Thank you, Mr. Chair. This question is for you, Mr. Dale. In one of your recommendations, you talked about short selling and putting limits or guardrails on that. Can you elaborate on that comment?
Yes, thank you for that question. Short selling has become a greater phenomena in the last several years, and in some ways it's been abusive, and in particular to illiquid companies, many of which are companies that are listed on the junior stock exchange. So the short sellers are required to cover their short positions by having access to the securities to cover it, if called upon. In many cases, they're using warrants that they hold that are not traded to cover that short position. And again, in many cases, those warrants are exercisable at a price that's below the market. So I think that's something that should be looked at, because it's unlikely that you would exercise that warrant to cover a short position if it's going to create a loss for you. What they have been able to do is defer the settling of those trades, or can continue with them for some time, and then eventually cover it through perhaps a new issue that's being done instead.
Urge you to put that on paper for the benefit of the committee. Thank you.
Thank you. Good idea, Senator Verney. That could be helpful to increase our background regarding that short-selling issue. Senator Marshall, to be followed by Senator Friedlander.
Thank you very much, Mr. Chair. So, Mr. Dale, you mentioned, I think right at the beginning of the remarks, that the problems were the regulatory burden and the high costs. And then throughout your testimony, you referenced, the cost of audited financial statements, all those forms that got to be filled out and all the rules. So how do we compare with the United States with regard to the regulatory burden? Like, do they not have that same problem, or is our regulatory burden much more burdensome?
Again, thank you, Senator. That's an excellent question. The irony is, as a Canadian investment dealer, the ability for us to actually conduct business in the U.S. is severely limited to those companies that are able to set up a U.S. subsidiary. So I don't have a lot of detailed knowledge on that, other than I follow what we're doing in Canada in the rulemaking, and often we follow U.S. rules to be harmonized with what they're doing. I think maybe the difference for us is that we have smaller companies that are trying to go public in Canada on our junior markets. The U.S. junior markets junior companies tend to remain private longer and then go on to the public markets at a much larger size because they have more access to capital. So we're competing with the U.S. market, certainly, but to compete with them, we can't match what they do. We have to be better. We have to make things easier, not just match what they do, or in some cases make it more difficult.
Just, you gave some examples, like you said, the cost of the financial statements. So I'm an auditor, so I appreciate that, the high cost. And then all the forms. Is there something else, like I'm trying to relate to what these small companies have to cope with. So I know that they have a multitude of forms. I know they got to have the financial statements, which costs a lot. What other items are very, very costly?
Well, in some cases, it's not only the cost, and I thank you for the question. There are a lot of costs. But in Canada right now, a lot of the audit firms are limited in their ability to support junior companies because they have limited staff. So a lot of the larger audit firms are concentrating their staff on larger companies where they do quarterly reviews and filings and a greater certainty of collecting their receivables. So a lot of junior companies are having more and more difficulty finding an audit firm that would be willing to conduct an audit, and then have to have some assurance that they'll have the ability to pay them. So that's one issue. That's not necessarily answering your question, but the same is true in for securities lawyers. And I think to some degree the costs, the hourly costs have gone up, as they have for auditors. And again, companies that are constrained in the amount of capital that they have are often reliant on doing a financing to pay for those auditors and those securities lawyers from the proceeds of those financings. So there's risk associated with providing those services and ensuring that you're going to get paid for the work you do.
Thank you.
Thank you, Senator. Senator Deakin.
Thank you very much. I thought Senator Freed had no reserve.
So Senator Deakin.
Let him go and I'll go after. I'm sure he's not going to steal my question.
Okay.
Oh, don't be so sure.
I know.
You got the good ones. Companies often go public too early. They haven't really settled on their go-to-market strategy. They don't, the ability to fund, to say we've got the mechanism now to fund this growth, justify that investment. And that's where they really need to be. And then the costs and the public scrutiny that come with quarterly reporting and whatever else. I think it's, so but we don't have public markets when companies have to have a liquidity event, and they're capping out on the ability of to raise funds in Canada. They're out of the country. So we're in a tough spot as a country right now. So looking for practical solutions, we need to increase the amount of private capital available. We've got to use things like the rollover scheme in the UK, their enterprise investment scheme, which is like equity tax credits. I don't know if you're familiar with that program or not, but I look at the opportunity of it's died, but I think it's going to come back, is the focus on interprovincial trade and investment. The federal programs that Senator Pupatello was talking about, to whatever extent they are helpful, quite often they're restricted to a jurisdiction. And so you get a really good organization going, and it's regional, it's not national. Your thoughts on getting there from here, because we've got to go for some interim measures and some long-term approaches if we're going to solve this problem. Is that a fair summary? And then what would you suggest?
Thank you for the question. That's really the most difficult question to answer, because there are some short-term measures that could be done, and I mentioned some of those in my recommendations. But it's we're competing in a way for dollars with companies that are marketing crypto assets or betting platforms that have huge marketing budgets, and you see their ads all the time. We don't advertise for our junior markets. So if we had some way of raising, some way to market and raise the awareness for investors that there is an avenue to help good Canadian companies become listed, and where those companies will be successful, they'll be successful as well, that's one thing that we could look at doing and supporting, in my view. I think the other thing that we should remember is that companies should be allowed to fail, and every investment doesn't make money, and I think investors should have the right to invest and lose money, as long as they're not losing money because the management are doing fraudulent things or stealing their money or running away with it. But if it's a legitimate business that's doing their best to get started, they may run into unforeseen problems that may delay their progress. But we have to give them the opportunity to be entrepreneurial, to win or sometimes lose.
And I think that reinforces the importance of the flow-through share idea, because let's use those losses to help the company succeed, but using that mechanism for R&D expenses and well beyond oil and gas and mining, 100%. And it built the Alberta oil and gas industry, the flow-through share model, without question. Yeah, thank you.
Thank you, Senator Deakin. Senator Friedlander.
Just one comment before I ask a question. When we talked about all these companies exiting and the grants that they get, I think that there should clearly be attached a clawback on the grant money if the company's going to exit the country. If it's not going to exploit its IP, if it's not going to exploit whatever it's developed here, the grants made by the government should have a clawback mechanism. And maybe there's an earn out over time, and there's a sunset, but you shouldn't be able to get $1 million grant one year, and then the next year the company sold to an American company, and they move everything to Denver or to Virginia or wherever. So comment on that. But I'm going to throw a crazy idea. We've got this government set up the MPO, Major Project Office, to make things good and efficient for big companies to get big projects done. But they forgot about the small companies, and maybe we need an SPO, something that the federal government looks at to consolidate the way it operates vis-a-vis SMEs. So there's lots of programs in different departments to provide grants. There's fights on, losing tax points with finance, on giving up on flow through. Like, this stuff needs to be not siloed all over the place, but actually brought together in an office that actually looks at how they're going to bring all this together for small and medium-sized enterprises. And so whether it's an SPO or an SIPO, a small IPO office, but the feds can exert a lot of pressure and in coordination of what they're doing if they consolidate this rather than siloing it all over the place. Just an idea to throw out there.
Any reaction on your side?
I think it's a wonderful idea. Talking as an SME.
So, colleagues, I don't know if you have any other question. Otherwise, I will Senator Lefreda. Sorry, go ahead.
Thank you, Mr. Chair. We have a productivity problem in Canada, right? One of the problems, besides competition being an issue, major problems. How directly does limited access to capital translate into Canada's productivity challenges? And are SMEs delaying, and you speak to many SMEs, are they delaying investments in technology or expansion due to financing constraints? And I do believe that we're not doing enough to support non-traditional financing channels such as private markets, venture debt, fintech solutions. And the government maybe should play a bigger role, because I believe there is a financing missing middle in Canada. Right, I believe there is a missing middle. Maybe you can share that thought or your concerns or on those issues.
I'll try to do my best. So, I mean, recognize first of all that I'm from the West, from Calgary, largely a resource-based city. Our highest productivity comes from our natural resources that we export: oil, natural gas, and mining. So if we can concentrate on producing and exporting and satisfying our country's needs in those resources, that would increase our productivity as a nation. But knocking it down to the junior markets, I think, if you have to delay your investment in equipment or technology or other things that prevent you from moving forward, you're also limiting the productivity of those smaller companies that are trying to do more with what they have. You can't do more with less.
Thank you.
Thank you. Senatrice Ringuette.
I come from New Brunswick, and I know that New Brunswick has provincially a credit program for local investment, okay? So this is triggering my mind in regards to, could it be possible to group, for instance, New Brunswick SMEs that are in search of capital into one stock for the junior market, and I see that that it would bring credit from the province, first of all, okay, because of the provincial program. And then it would also provide a de-risking factor because of the grouping. Could that be possible?
Senator, thanks for that question. I think it's an excellent question. And, I think there are avenues for the aggregation of junior companies into a fund that could be traded. We haven't, as a company, looked into doing that because we aren't a manufacturer of funds in our firm. But I would think that there are fund companies out there that could look at it, and whether or not they would make money on it is a good question. And I guess maybe that's why they haven't done it to this point. But it would be an excellent mechanism for an investor to have access and de-risking it. Yes. Through a venture-focused mutual fund. There are some smaller ones out there, and a past colleague in Vancouver started their own firm, and they had been successful in terms of generating profits through the fund, but it's not very well known, and it's not, again, it has grown through the years, but it's not very large.
I find that it would be a way to, I think that New Brunswicker seeking to invest would be, excited a little bit to invest in New Brunswick, moving forward, okay, and the companies in New Brunswick moving forward, and at the other end, it would provide more access to fund for New Brunswick SMEs. Anyway, okay, thank you.
Thank you, colleagues. Maybe we have some time, but I will have maybe 6 minutes left, so I will go with my question and recognize maybe 2 other senators. So you propose, Mr. Dale, you have 4 recommendations regarding the federal government proposal. Could you elaborate a little bit more regarding the second one, some for venture list companies with revenue above some threshold allow capital gains deferral when proceed? And you refer to UK, but is it the case as well in US side regarding that particular recommendation? Or any of them that you recommend that US exists, but it's not the case in Canada? If you could elaborate?
I'm most familiar with the UK situation, Senator, but I think there are various programs in other countries as well. The UK one, I think, is an example that could work very well in Canada, and it's not a huge cost in my mind for the government. It's a deferral, and we already have tax deferral programs in place for things like investments in RSPs and so on. But this would be, I think, a very good program that would stimulate interest and investment in the junior markets specifically.
U.S. venture market will come to Canada, and apparently they have this kind of thing exists. So we will see. Okay, colleagues, maybe third round, Senator Deakin, Yusuf, if you have a...
You're still second round, aren't you?
Singlese, I'll come back because I wanted to. I have more knowledge than my colleagues on this, and maybe you could elaborate a bit more. In Quebec and the regional development maturity that they've had for such a long time, and the Quebec Solidaire Fund that plays a significant role, and other funds in that, it's been extremely valuable for small FNEs and others because they are able to access that on a consistent basis. The fund has no more half this in the billions of dollars. And to a large extent, the provincial tax credit, the federal tax credit also that complements it, have shown extremely productive results over the years because there's a horizon you can look over a time. Can you elaborate a little bit more so colleagues might appreciate the uniqueness to that reality?
I don't have specific data on the success rate, but I could tell you that when I was a bit younger, I used to do income tax return when I was at a CA firm, and everybody had them, right? Everybody in Quebec would have them because it was a way of participating in your own economy. So I think, one thing that Jim said before is that we need to educate the investors right now because, nobody will stop them from spending their paycheck on crypto. But they don't know what's going on with the junior capital markets. If they would, I think they would be more interested in putting their money into, generating revenues and generating jobs for their kids and their grandkids. Yeah.
Thank you for raising that issue because Quebec, we have a Capital de Risque des Jardins, we have Fonds Solidarité, we have Investment Quebec, and even Quebec, many decades ago, they have a régime d'épargne action. Couche-tard, alimentation, Couche-tard, everybody know, but Couche-tard, they start with régime d'épargne action. So I think that they have something that we could think again regarding that and to encourage because people have to diversify their portfolio. And so rather than invest in one single company, when you invest in a fund who target the small and medium businesses, this is a way to participate and increase the wealth. So to conclude our panel, and Senator Deakin.
Thanks very much, Chair, and thanks again. Really an excellent session. I want to build off of the last 2 questions that you've had. Because we did have a national program, the Labour-sponsored Venture Capital Corporation program was not very successful for investors. But there has been a framework in the past that we can learn from lessons, fail forward, learn some lessons, and do something better. So there has been a model in the past. And it was very well received by Canadian investors. The beauty of it was it did have a lead investor that was doing the due diligence and giving you some confidence that your risks were being managed as a junior investor. And I think I contrast that with what was done 4 years ago, I think, with the Know Your Product rule that was put in place. Another layer of regulatory burden. And the banks immediately used that as a reason to say, okay, we'll just sell bank-owned mutual funds. And cutting out all competition. Now, there was enough pushback, but I think the point I want to get something on is we are anti-competitive in how we run our investment system. We're not encouraging. Too much of our money from those of us who don't live in Toronto ends up, the decision about our money gets made in Toronto. It does not get made in our communities or in our provinces or our regions. So I just would love you to focus on how do we, just the importance of making our industry more pro-competitive.
Would you like to start, or you want me to? That's an excellent comment as well as and a question as well that follows from it. How do we make ourselves more competitive? We have to be better than the competition. I think Senator McBean probably understands that. Right. Yeah. So you have to be better than the competition to succeed, and I think that's why we have some independent firms that still exist today, is that they've learned to be better in the market that we operate in. And have been successful. Others that haven't been able to compete have been targets of acquisitions, or they've simply closed their doors. So when we look at what we can do to be more competitive, we just have to deregulate. We have to have less regulation instead of more. We've got an apparatus, a regulatory apparatus in Canada that is in the business of generating more regulation, which keeps Annie and I very busy providing feedback to them in terms of why these regulations will or won't work, or if they're needed or not needed. But there's no requirement for regulation to pass a cost-benefit test in Canada. And that's something that would help a lot.
Perhaps for the regulations to be more balanced so that there aren't the biggest monopolies dominating because they can afford them. But the other thing is, I don't think it's a matter of making it riskier. There's different ways of managing identified risk that doesn't eliminate opportunity. I think, is that a fair way of saying it? Thank you.
So, as you can notice, they have a lot of expertise around the table, so it's very, very helpful discussion. So we want, on behalf of my colleague and myself, to thank you a lot. It was very, very helpful today. I think that following Senator Veroni's intervention on short selling, it will be appreciated if you can send some written elements regarding to explain to us exactly how it's working. It will be helpful for us as well. So, colleagues, our next meeting will be on Wednesday, March 11, because next week is not a non-sitting week. So, on your behalf, colleagues, we want to thanks our witnesses today, but thanks as well our interpreters, our clerk, and our research analysts, and all the people, the logistic who make that meeting happen. So I declare the meeting adjourned.